Welcome back to the Deep Dive. Today is Wednesday, January 28th, 2026. And if you follow the markets, or really if you just follow the future of technology, today is one of those days.
It's a big one.
It's a really big one. We're sitting here right in the immediate aftermath of one of the most anticipated, and I've got to say one of the most intellectually confusing earnings reports in recent tech history.
That's a great way to put it, confusing, because this isn't just a quarterly report where you tick the boxes. This feels like a manifesto from Microsoft.
It does, a statement of intent. And just to set the stage for everyone, the context here is absolutely wild. Microsoft just dropped their numbers a few hours ago, and if you just glance at the headlines, they crushed it.
Oh, completely.
Revenue, beat. Earnings per share, beat. The cloud numbers, a massive beat. And yet, if you look at the ticker right now, in after-hours trading, the stock is flashing red.
It's down, what, 5, 6, 7%?
Somewhere in that 5 to 7% range, which is the central tension, right?
Yep.
It's the whole reason we're doing this deep dive.
It's the classic good news is bad news scenario. Or maybe more accurately here, expensive news is scary news.
Exactly. And that's the core paradox we're going to unpack. It's this double beat paradox. Microsoft is making more money than ever before. I mean, cash is just flowing into Redmond like water.
But they're spending it even faster. They are betting the farm, the barn, the tractor, and all the livestock on this AI revolution.
They really are. And so our mission today is to go through this research stack we have, the analyst reports, the transcripts, the raw financials, and really analyze this transition. Because what the sources are telling us, and this is a fascinating phrase.
I think I know the one you're talking about.
Microsoft is shifting from a software company into an industrial infrastructure utility.
Right. And when you hear that, it changes everything. It's not about code anymore. It's about steel and concrete and power grids.
It sounds so heavy. It doesn't sound like software.
And that's the point. This is what the deployment phase of the Gen AI revolution looks like. We are past the hype cycle of 2023, 2024. We're done with the, wow, look what this chatbot can do phase.
Right.
Now it's about building the factories. And, well, factories are really, really expensive.
So we have a lot to get through. We have billions of dollars flying around, a backlog of contracts that's literally the size of a national economy. We'll get to that. It's mind-blowing.
It's incredible.
And a stock market that doesn't know if it should cheer for the growth or panic about the cost.
It's a fascinating dynamic. So let's start with the scorecard.
All right, let's do it. Slide 1, the at-a-glance scorecard. Okay, so let's get the headline numbers first.
Yeah.
This is the stuff that flashes across the business news channels. Microsoft reported revenue for the quarter, $81.3 billion.
$81.3 billion. Just pause on that for a second.
It's a massive number. It's almost impossible to wrap your head around.
Well, think about it like this. That's for one quarter. If you annualize that, you're looking at well over $320 billion a year. That's bigger than the GDP of Finland.
Wow.
It's bigger than the GDP of Portugal. This isn't just a company anymore. It is an economic superpower.
And that revenue is up 17% year over year.
And 15% in constant currency, which, strips out the currency fluctuations. But let's stick with 17%. For a company this size to be growing at 17%, I mean, we talk about the law of large numbers in finance all the time.
Yeah, refresh us on that, the law of large numbers.
Basically, it just says that the bigger you get, the harder it is to grow quickly. It's easy to double your revenue when you make $1 million. You just have to find another million.
Right.
But when you're making $80 billion a quarter, to grow 17% means you have to find an additional $12 billion or so in new revenue in 3 months.
They basically created a Fortune 500 company inside of themselves in a single quarter.
It defies financial gravity. It really shouldn't be possible at this scale. And they beat the street's consensus, right?
They did. Wall Street was looking for about $80.3 billion. So they cleared that by a full $1 billion.
Comfortably. But the number that really shows the discipline here, and this is where we get into the mechanics of how this machine really works, is the bottom line. The earnings per share, EPS.
Okay.
They came in at $4.14 non-GAAP.
And the expectation from analysts was around $3.88.
Right. So that's not just a beat. That's a huge beat in the world of earnings. And it's a 24% increase in earnings year over year.
Wait, hold on a second. Let me do the math. Revenue's up 17%.
Yep.
But earnings are up 24%. So profits grew faster than sales.
That's it. That is what we call operating leverage. And it's the holy grail of business models. It means that for every new dollar of sales they bring in, they're actually squeezing out more profit than they used to.
But how? I mean, the whole narrative lately has been that AI is expensive, the
Mhm.
chips, the energy, the costs. But you're saying that in the non-AI parts of the business, they're actually tightening the belt.
The sources are very clear on this. It's a critical piece of the puzzle. Operating expenses, OPEX, are being managed with just extreme discipline. Think about the legacy divisions. Windows, the standard office stuff, the back office.
Mhm.
They're keeping headcount relatively flat there. They're not hiring huge armies of salespeople for the old
So
products.
they're just squeezing the lemon.
They're squeezing it dry. They're cutting discretionary spending. They're probably using their own AI tools internally to write code faster or handle customer service tickets, which suppresses costs. They're running the old Microsoft as lean as possible.
So they can take all that cash.
Every single spare dollar and funnel it into the new obsession, which is this AI build-out.
So it's like there are two companies under one roof. One is this ruthless, efficient cash cow that they're milking for everything it's worth.
And the other is this hungry, cash-burning startup that needs billions of dollars to grow. It's a perfect symbiotic relationship. The old Microsoft funds the new Microsoft.
Okay, but here's the paradox again. We have a double beat, revenue and earnings. Usually that sends a stock through the roof.
Pop the champagne.
Exactly. So the fact that the stock is down 5 to 7% tells you the market is looking past these great numbers.
The market's asking a different question. It's saying, okay, Satya, you made $4.14 a share. That's great. But what did it cost you to build the future? And is this whole model sustainable?
Right. And to understand the future, we have to look at where all that growth is actually coming from. Because it is not coming from selling boxed copies of Windows anymore.
No, it certainly is not. The center of gravity has shifted completely.
Which brings us to the real engine room. Slide 2. The engine of profitability. This is the part of the report that everyone obsessively checks first. If you're a trader, you hit Control F and you search for this immediately. The Intelligent Cloud segment.
This is the heart of the modern Microsoft. Without this, the company is just another legacy software vendor.
So the total segment revenue was $32.9 billion, up 29%. But the star of the show, the metric that usually dictates where the stock goes, is Azure.
Azure and other cloud services. This is the direct competitor to Amazon's AWS and Google Cloud. This is where the war is being fought.
And the growth number there was 39%.
39% and 38% in constant currency.
Let's put that in context. The whisper numbers, what analysts tell each other but don't publish, they were hovering around 37, maybe 38%. So this is a legitimate beat.
It's massive, and we really need to unpack why 39% is such a huge deal. A year or two ago, remember, there was this big fear that cloud growth was stalling. We had that optimization phase.
I remember that. Companies were cutting their cloud bills. The narrative was cloud is mature.
Exactly. This 39% growth basically confirms the second wave thesis.
Explain the second wave.
The first wave was just lift and shift, moving your servers from your basement closet to Microsoft's data center.
Yeah.
That's mostly done for the big companies.
Okay.
The second wave is generative AI. It's companies renting massive compute power, not just to store files, but to run models, to query data, to build AI applications that can reason and create. That 39% growth proves that AI isn't just a science project anymore. It is driving actual consumption.
But the sources mentioned something fascinating about this number. They called it a supply-constrained number.
Yes, this is critical. If you miss this detail, you miss the whole story. Microsoft management said it explicitly on the call. Demand for their Azure AI services exceeded their available capacity.
Okay, let's translate that into plain English. That means customers were standing there waving money saying, we want to buy more compute power, we want to run more models, and Microsoft had to say, sorry, we're sold out.
That's essentially it. Imagine a bakery that sells out of bread by 10 a.m. People are lined up down the block, cash in hand, but the ovens literally cannot bake fast enough. Microsoft is in that exact position with GPU capacity. They cannot physically build the data centers and plug in the chips fast enough to satisfy the demand that's out there.
That sounds like a problem, but I guess it's a high-quality problem to have.
It is the best problem you can possibly have. It implies that the 39% growth rate is a floor, not a ceiling. If they had more capacity, that number would have been 41, 42, maybe even 45%.
It's only limited by how fast they can pour concrete and secure power cables.
Exactly. It's limited by physics and supply chains, not by customer interest.
Now, how much of this is actually AI? Because Azure's a lot of different things, right? It's storage, it's networking, databases.
Right.
Is this just normal cloud stuff, or is AI really driving the bus here?
The report gives us some good clues. In previous quarters, management said AI contributed about 6 or 7 percentage points to that growth number. With total growth now accelerating to 39%, the analysts in our source pile are estimating that AI's contribution is now likely in the double digits.
So it's becoming a huge chunk of the pie.
A huge and growing chunk. And of course, you can't talk about Azure without talking about OpenAI.
The circular economy.
The circular economy, right. This is the part that makes some skeptics a little nervous. OpenAI is a massive customer of Azure. They run ChatGPT on Azure. But Microsoft also owns a huge chunk of OpenAI.
So Microsoft invests billions into OpenAI, and then OpenAI turns around and pays Microsoft for cloud hosting.
It is a bit circular. You give me $1, I buy a lemonade from your stand. Did you really make $1?
Exactly. Is that real revenue?
It does muddy the water slightly if you're trying to calculate purely organic growth.
Yeah.
But here's the counter-argument. OpenAI isn't just burning that compute for fun. They are selling ChatGPT subscriptions. They are selling API access to developers. There is real end-user demand driving that consumption.
So the demand at the end of the chain is real, even if the loop is a little weird. Okay, so the engine is running red hot. But what about the rest of the ship? Because Microsoft is still more than just a cloud company. They sell software to basically every business on the planet.
Correct. And if Azure is the engine, the rest of the business is the high-octane fuel that keeps it running. And the backlog.
Oh boy, the backlog.
Let's get to that. Slide 3. The engine room business segment performance.
Okay, this next slide has a number on it that I actually had to double check. I thought I was misreading the zeros.
I know exactly which one you're looking at.
We are talking about RPO, remaining performance obligation.
This is one of my favorite metrics because it's the crystal ball.
Yeah.
Revenue tells you what happened in the last 3 months. RPO tells you what's going to happen in the next few years.
But let's define it clearly. What exactly is RPO? It's not cash in the bank, right?
No, it's not cash yet. Think of it as the check is in the mail metric. Or better yet, that wedding caterer analogy.
Okay, the caterer, I'm with you.
If a caterer sells a sandwich today, that's revenue. Immediate. But if a couple comes in and signs a binding legal contract for a massive wedding next year, that $50,000 they've promised to pay, that's not revenue yet. But it is an obligation. It's locked in future money.
Okay, so it's the backlog, the signed contracts that haven't been fulfilled yet.
Exactly. And Microsoft's backlog just went nuclear.
The commercial RPO surged 110% to $625 billion.
110% growth. $625 billion.
I mean, how do we even conceptualize that? $625 billion is bigger than the entire GDP of Sweden. It's bigger than Belgium's GDP. It is a medium-sized European country just sitting in Microsoft's backlog.
It's a staggering, almost incomprehensible amount of locked-in value. And what it tells you is that there's a massive shift in how big companies are buying technology. You don't get a backlog that big by selling monthly subscriptions.
No.
You get it by signing 5, 7, maybe 10-year contracts with the biggest companies in the world.
So these companies are locking themselves in for the long haul.
They are terrified of being left behind in the AI race. The CEOs of the Fortune 500 are looking at this and saying, we need this infrastructure, period. So they're going to Microsoft and saying, we need to guarantee access to this compute power for the next decade. They are reserving capacity.
Which creates an incredibly deep moat for Microsoft. If you're Google or Amazon trying to steal a customer, and that customer has already signed a 5-year deal with Microsoft for OpenAI access.
Good luck. It's game over for that account. It provides incredible visibility for Microsoft. Even if the economy crashes next year, those contracts are signed. That $625 billion is coming in eventually.
It's an insurance policy for their revenue into the 2030s.
Precisely.
Now let's look at the productivity and business processes segment. This is the stuff we all use. Word, Excel, Teams.
The cash cow, the fortress. Revenue here was $34.1 billion, up 16%.
And the margins here are just, they're beautiful, right?
They're around 60%. This is the fortress that is funding the entire war. For every dollar of Office 365 they sell, 60 cents goes straight to operating profit.
And Office 365 commercial is up 17%. I feel like everyone already has Office. How are they still growing it at 17%?
It's the upsell. This is the masterclass of Microsoft's strategy. It's not just about adding new users. They are moving companies from the E3 license to the E5 license.
E3 to E5, what's the difference there?
E5 includes more security, more analytics, more compliance tools. It costs more. And now, the kicker, Copilot.
That's the AI assistant, the super-powered Clippy,
The very, very expensive Clippy. It costs $30 per user per month.
which is steep. I mean, the base subscription might be 20 or 30 bucks. Copilot can literally double the bill for a user.
It does. But if you can prove it saves an employee just 1 hour a week, it pays for itself almost immediately. And we're seeing early adoption of that, driving that 17% growth.
And Dynamics 365, this is their Salesforce competitor.
Up 19%.
They are really coming for Salesforce, aren't they?
They are. And their pitch is all about integration. Why pay Salesforce separately when all your data is already in Outlook and Teams? Just use Dynamics. It's a powerful argument, especially with AI layered on top.
At LinkedIn.
Up 11%, which honestly is surprisingly resilient.
Why surprising?
Because usually when the job market cools down, LinkedIn takes a hit. Fewer recruiters paying for premium tools, but they're keeping it in the double digits. It shows it's become an essential tool, not discretionary spending.
So to synthesize this slide,
Yeah.
you have the cloud booming at 39%. You have the legacy software business growing at 16-17% with massive margins. You have a backlog the size of a nation.
Right.
This sounds like the perfect company.
Yeah.
Why on earth did the stocks drop?
Well, now we have to talk about the bill.
The bill.
You don't get a $625 billion backlog for free. You have to build the machines to service it. And that brings us to the number that sucked all the air out of the room.
Slide 4. Financial strength and shareholder rewards. Okay, this brings us to the elephant in the room, capital expenditures, CapEx.
This is the number that made the algorithm sell the stock in the after hours. This is the number that made portfolio managers spill their coffee.
The number is $37.5 billion
In 1 quarter.
in 3 months. $37.5 billion. I just want to pause and let that sink in.
Please do.
If you annualize that, if they keep this pace up, that's a run rate of $150 billion a year. $150 billion. You could buy the entire airline industry for that.
It's an absolutely unprecedented number. We have never seen a company spend this much on capital equipment in the history of business. Not Standard Oil, not the telecom buildouts of the 90s. This is a new category of spending.
I said earlier, that's not software money, that's oil rig money.
It really is. And it marks that transition we talked about. Microsoft is becoming an industrial utility. They are building AI factories.
Explain that term AI factory. I mean, I still think of Microsoft as people in hoodies writing code.
Forget the hoodies. Think hard hats. Think high voltage. An AI factory is a data center, but it's not like the old ones. These new ones are beasts. They're highly specialized facilities designed for liquid-cooled, high-density GPU clusters.
Liquid-cooled.
Yes, these new NVIDIA chips run so hot that air cooling isn't enough. They would melt. So you have to plumb the entire building with liquid cooling systems. You have to secure massive amounts of power.
So they're pouring concrete, laying copper, buying steel.
And buying silicon. A huge chunk of this money is just going straight to NVIDIA for the H100s and the new Blackwell chips.
Yeah.
Each one costs $30,000, and they're buying them by the hundreds of thousands.
And this is where the risk comes in. This is the depreciation trap.
This is the entire bear case in a nutshell. If you spend $10 billion to build a bridge, that bridge lasts for 50 years. You depreciate it slowly. But if you spend $10 billion on GPUs, how long does a GPU last?
My gaming PC struggles after about 4 years.
Exactly, 3 to 5 years. Maybe even less if the technology keeps accelerating. If NVIDIA releases a new chip next year that's 10 times faster, your old chips become obsolete.
Ouch. So all that money they just spent, it just vanishes.
Not vanishes, but it loses value incredibly fast. That's the depreciation expense. It hits the income statement and it crushes your gross margins. It means you have to keep spending $150 billion every few years just to stay in the same place.
It's a treadmill that keeps speeding up. That's terrifying.
That's the fear. The fear is that this is a capital destruction cycle, that AI is so expensive to run that you can never actually make a profit on it, no matter how much revenue you bring in.
But Microsoft's argument would be,
Microsoft would say, look at slide 3. Look at the $625 billion backlog. We're not building a field of dreams here. We aren't building it and hoping they will come. They've already signed the contracts. We are building to order.
so they've pre-sold the capacity.
Exactly, which de-risks it significantly. But the sheer scale of the spending is still shocking to a market that's used to software companies with 90% margins.
There was also a note about finance leases. A big chunk is leased.
Yes, they aren't paying cash for all of it. They're leasing data center shells, leasing equipment. It helps preserve their cash pile, which is still massive at almost $90 billion. But it creates long-term liabilities and interest payments.
And speaking of cash, despite all this spending, they're still giving money back to shareholders.
They returned $12.7 billion to shareholders in the quarter, dividends and buybacks.
That feels like a mixed message. We're in a life or death struggle to build the future. But here's $12 billion. Go buy yourself something nice.
It's a very delicate balancing act. They know if they cut the dividend or stop the buybacks, the stock would crash. It would signal panic. So they have to keep the value investors happy while they pivot to this growth story.
One more thing on the financials, the OpenAI accounting note. There was a weird line item about a $7.6 billion gain.
Right. This confuses a lot of people. If you look at the GAAP net income, it looks huge. And that's largely because of a $7.6 billion paper gain on their OpenAI investment.
So this isn't cash they collected. They didn't sell their stake.
No, it's just a revaluation. OpenAI raised money at a higher valuation, and under accounting rules, Microsoft gets to write up the value of their stake. It boosts the GAAP EPS to over $5 a share.
But we should ignore it for operational purposes.
You have to ignore it. It proves they made a smart bet, sure, but it doesn't pay the electricity bill for the data centers. Stick to the 414 non-GAAP number.
Got it. Okay, so we've seen the scorecard, the growth engine, and the massive bill they're racking up. So what does management say is next?
Slide 5. The road ahead management's outlook and key takeaways. Let's look at the lagging segments first, because not everything is rosy in Redmond.
No, we have to talk about more personal computing. This is the third pillar of the company.
And revenue there was $14.3 billion, which was down 3%. And this is the drag. You have the cloud rocket ship attached to an anchor.
What's the anchor?
Xbox and Windows OEM. Xbox content and services were down 5%.
That's really disappointing. I mean, they just bought Activision Blizzard for $69 billion. They own Call of Duty. You'd think that would be fueling massive growth by now.
It suggests a broader cyclical downturn in gaming. People are just spending less time or less money post-pandemic. Maybe some subscription fatigue with Game Pass.
And on the Windows side, the revenue was basically flat.
Flat, plus 1%.
But I keep hearing about the AI PC, that we're all going to rush out and buy new laptops with special chips, the super cycle.
It hasn't happened yet.
Why not?
Because for the average person, your current laptop works just fine. The killer app that forces you to upgrade your hardware isn't there yet. Copilot is cool, but do you need a new $2,000 laptop to run it? Not really. It runs in the cloud.
So the consumer side of Microsoft is basically in a hangover.
It is, and that creates this strange bifurcation in the company. Enterprise is booming, consumer is busting. And it puts even more pressure on the cloud business to carry the entire load.
Satya Nadella had a really interesting quote in the earnings call. He called this the jagged intelligence phase.
I highlighted that too. It's a very honest assessment of where we are.
What does he mean by jagged?
He means that AI is uneven. Think about your own experience with it. Sometimes it writes a brilliant poem or solves a coding error instantly. That's a peak. But then you ask it a simple logic puzzle and it completely hallucinates. That's a valley.
So it's spiky. It's not perfect yet.
It's spiky. It has jagged edges. And Microsoft's strategy is to try and smooth out those edges, to integrate it so deeply into everything from the chip to the app that the user doesn't have to worry about the jagged parts. They want it to be a utility, like electricity.
Looking forward, the outlook mentioned that capacity constraints will persist through the fiscal year.
This is the key takeaway for the next 6 months. Revenue is capped. They literally said they cannot grow any faster because they don't have the servers. So don't expect a massive upside surprise next quarter. They're building as fast as they can.
And margins.
Margin compression. Investors just have to accept that free cash flow yield is going to be lower for a while. This CapEx cycle is eating the cash.
So let's circle back to the beginning. The stock is down 5 to 7%. If the fundamentals are this good, if the backlog is huge, why the sell-off?
I think it comes down to 3 main things.
Okay, hit me.
1, AI fatigue. Investors have heard the story for 2 years. They're seeing the spending, but they aren't seeing the profit margins expand from AI yet. They're seeing revenue, but not the massive profit explosion they hoped for.
Okay, number 2.
CapEx shock. $37.5 billion is a scary, scary number. It scares the generalist investors who think, wait, is this an arms race where everyone loses? It reminds people of the telecom bubble in 2000, where companies spent billions laying fiber optic cable that nobody used for 10 years.
That is a haunting comparison. And number 3.
Valuation. At $3.5 trillion, Microsoft is priced for absolute perfection. And when you're priced for perfection, good isn't good enough, you need to be God tier. And while this report was great, that CapEx number spoiled the perfection.
So the price has to come down to match the new, more expensive reality.
It's a healthy reset, really.
All right, let's wrap this up. So after diving through all the slides, all the billions of dollars, the backlog, what's the final verdict on this quarter?
It is a beat, unequivocally. The fundamentals of the business are rock solid. They are growing at a scale that just shouldn't be possible.
And that backlog really feels like the ultimate safety net.
That $625 billion RPO is a reason you own this stock if you're a long-term investor. It proves the demand is real. This isn't some bubble where nobody is actually buying the product. They are buying it faster than Microsoft can build it.
The stock dropped then.
It's a valuation reset, not a broken business model. For anyone with a long-term belief in the AI thesis, this is probably a buying opportunity.
I want to leave our listeners with one provocative thought. We talked about Microsoft becoming a utility.
Yes.
They are betting that AI is going to be as essential as electricity. If they're right, then spending $37.5 billion a quarter on CapEx is actually cheap. It's a bargain to own the power grid of the 21st century.
But
If they are wrong, if AI turns out to be just a really cool feature but not a fundamental utility, if it turns out to be more like 3D TV than electricity, then they are holding the most expensive bag of depreciating computer chips in the history of capitalism.
And that is the gamble. That's the $150 billion gamble. And we're all watching it play out in real time.
And we will be watching every quarter to see how it plays out.
Absolutely.
Just a quick reminder before we sign off. As a reminder, this analysis is generated by AI and does not constitute financial advice. Please do your own research.
And if you want to do that research properly,
Want institutional-grade stock research without the institutional price tag? Check out STOCKANALYTICS.AI. For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at STOCKANALYTICS.AI. Make smarter investment decisions with research you can trust.